Most traders believe that you can trade volatility indices any time of the day, but this is one of the biggest reasons why they keep losing money. In this video, I'm going to show you the exact time to trade volatility indices and the dangerous section you must avoid if you don't want to keep blowing your account. So without wasting much time, let's get started. Guys, before we proceed, let me quickly show you some of the trade that was taken on the same pair using the same strategy, and then let's see how the outcome looks like. Okay, the first trade was from this POI, and you can see that this trade actually smashed our take profits at a risk to reward of 1:6.67. While there is this trade that we took from here, the risk to reward is supposed to be 6.29, but it eventually took us out, hit our stop loss. Now there are other trades that actually smashed take profit. Now what is the difference? The difference is the timing. There are good times to trade and there are also bad times to trade, and that is why in this video I'm going to show you the exact time to trade volatility indices, and also the worst time you must avoid, and how you can also apply this thing to have a better entry. Now, it is true that synthetic indices operate 24 hours of the day, but this doesn't mean that it gives you same movements throughout the day. There are seasons where the market presents itself to be a clean and predictable market, and there are also times where the market presents itself to be dangerous and choppy. So these are the difference between these two results that you're seeing here. So I'm going to explain to you how you can avoid this bad season so that you can have a profitable trade ahead. If you look at my schematic carefully, you will see that there are different schematic describing different market movements. For instance, we have a market trending to the upward direction, we have another trending towards the downward direction, and we have these two markets, and these are the two examples of a choppy movement. These are sideways correction, and in a situation like this, as a trader, you cannot have good or high probability setup trying to analyze a setup like this, but you can always find high probability setup in a market that is clearly telling you that it is trending to the upward direction, or a market that is clearly telling you that it is trending to the downward direction. Now, what are the characteristics or the best time you can actually trade synthetic indices? Now, to understand the best time to trade is to know the characteristic that the market is showing you. And number one characteristic is the market needs to give you a clear directional movement. For instance, if you look at this schematic, these are markets creating series of higher highs and higher low, higher highs and higher low, telling you that the buyers are in total control of this market, as we can see that the market is pushing towards the upward direction. When you have a clean market like this, you can always know that you can find high probability setup, right? If you also find yourself in a market that is trending towards the downward direction and the structures are clean, you can always find high probability setup. Another thing you must pay attention to, or another characteristic you need to watch out for, is a clear break of structure. Now, when you look at this schematic, you can see that we have a break of structure to the upward direction, another break of structure to the upward direction, and we also have another one here. Similarly, for this bearish market, we are having the same thing. Okay, break of structure, break of structure, break of structure. So once you have these two things in check, you know that you are already seeing a market, or you are finding yourself in the best time to trade a particular synthetic pair. The next thing you must pay attention to is the kind of movement you are seeing on that particular market. The movement needs to be very strong. You need to see that there are strong momentum in the market. So once you are able to spot that a particular market is trending, that means it is clean. You can see that the market is giving you a clean structural break and you are seeing a strong momentum. Then you know that you are already in the right time to make a good trading decision. But when you find yourself in a market that is showing you this type of characteristic, this is the one you want to avoid by all means. So now that we understand what we want to watch out for to know that we are in the best time to trade a synthetic market, what is the worst time to avoid? This is where a lot of traders actually blow up their account, because they do not have the patience to wait for the market to present the best opportunity. They open their charts and they want to trade at all costs. Even if the market is not presenting the right opportunity, they just want to click buy or sell, and this is one of the reasons why they keep on blowing their account. So you don't want to be those type of trader. You want to start trading like a professional, so you need to avoid a market that is choppy. Now, to understand the movement in the market, you need to understand 4 stages in the market. There is a stage we call the ascending stage. We have other stage which is called the declining stage. Then we have the distribution stage and the accumulation stage. Now, the first stage, which is the ascending stage, is when a market is clearly in a bullish movement, just like this schematic that you're seeing. You can see that the market is clearly trending towards the upward direction. Now, an ascending stage is the type of stage you want to pay attention to. When you find out that the market is in a state of ascension, then you know that you are in the right time to trade synthetic indices. Another time again to trade is when you notice that the market is in a state of declining. When you find the market in this particular state, you are also in a good time to actually trade synthetic indices. Now, the 2 stages of the market you must avoid is the distribution stage and the accumulation stage. Now, what is the distribution stage? The distribution stage is when you notice that a market is initially bullish and it gets to a point and you start seeing this type of choppy movement. When you get to a particular stage where you are observing this in a bullish market, you know that it is possible that the trend of that particular market is coming to an end and there is a possibility for a reversal. So once you find yourself in a distribution stage, you will want to avoid that market. Now, accumulation stage comes after a declining stage. Now, when the market declines, that means when the market starts selling for a particular period of time, it will get to a point where it starts showing this sideways correction. Now, this sideways correction is a sign that this declining stage is coming to an end, and that is the period you have to avoid as a trader. You don't want to trade in this type of stage or in this type of phase. So if you can avoid this, you will always look out for what high probability setup on the ascending stage and the declining stage. Now that you've understood all of this, how do you apply this knowledge that you are deriving from this video to your trading style? The simplest way to apply this knowledge is, before placing any trade, you need to ask yourself one important question, and the question is this market messy or clean? Now, when a market is messy, that means that you are in either a distribution stage or an accumulation stage, and you want to avoid those 2 stages. But once you notice that the market is clean, that means that you are either in a declining stage or in an ascending stage. So once you have been able to answer this question, that will tell you the kind of action to take, whether to stay back or to take an action. And another thing you need to do is you need to have a working strategy, and that is why this will help you if you can go back to the previous video where I talk about sniper entry that you can use to trade any synthetic pair. So you can go back to the previous video to watch and understand the simple strategies that I've explained. It is suitable for beginners or any struggling trader. So I believe that you enjoyed this video. If this is your first time of viewing my content, kindly make sure you subscribe to the channel and share this video so that others can learn and benefit from it. So this is where we'll be stopping, and hope to see you in our next video. Peace out, guys. Case.